So we're getting towards the end of this course. Unit 6 is types of insurance, so let's get started and talking about types of insurance. So why is it important to have insurance? Risk, the definition is the chance of loss from an event that cannot be entirely controlled. And that is managed by an emergency savings. Remember, we want to have at least 6 months expenses set aside to cover unexpected expenses. But we are also going to have insurance. And insurance is a financial product purchased by many people facing a similar risk to protect against the risk of larger losses. Think about all the unexpected things that can happen. We never know if we're going to get injured and have to go to the hospital. Perhaps we get really sick and need medical treatment. Even our house could burn down, or all kinds of things can happen. And so insurance is a way to manage our risk. So those are just some examples. A policy is a contract between the insurance company and the insured that states the exact terms of the policy. So inside the policy, it's going to say what is covered, how much is covered. Everything will be stated in that policy. The coverage is the risks covered and the amount of money paid for losses under an insurance policy. So if you file a claim, which we'll talk about, that would tell you what would all be covered in that. The policyholder is the person who owns the insurance policy, and the premium is the money you pay to purchase the policy. And you may pay that every 3 months, every 6 months, or once a year, but you need to pay the premium in order to be covered for the insurance. Experts say that buying insurance is buying financial security. Do you think this is true? A lot of people can sleep better at night knowing that if something were to happen to them, insurance would cover it. So that's why it's compared to buying financial security. So here's an illustration of how insurance works. Suppose there are 100 people in a health insurance group with a 1% chance that any one of them could get sick and require $10,000 in medical care. No one knows who will get sick. If each person pays $100 into a pool, they'll have $10,000 to cover the medical costs of the person who gets sick. Everybody gives up 100. No one loses more than 100. 99 people do not collect anything, but they gain peace of mind and important protection against a large loss. So that's a good example of how insurance works. Insurance shifts the risk of big loss from the individual to the insurance company. So if something happens to you, you are not solely responsible. There are benefits of insurance. The payments received from an insurance policy can far exceed how much you pay, the premiums. It provides financial security and peace of mind. And we will elaborate on these different types of insurance: property and liability, health, long-term care, disability, and life. The best outcome is to have insurance but never collect on it. That means that any of these things that happened did not happen to you, so you did not need to collect your insurance. So the event occurs resulting in a loss, and then the policyholder makes a claim to the insurance organization. A claim is a formal request to an insurance company asking for a payment when the policyholder has an accident, illness, or injury. Now, if it's something small, you might not make a claim to your insurance company because that could cause your prices to go up, but in lots of cases you would need to make a claim. An example that I have is I was parked at a baseball game and a ball came through my windshield. It actually got stuck in my windshield, and that would have cost about $200 to $300 to fix. And if I filed the claim, I would have to pay my deductible first, which we'll talk about again in a second. And so it wouldn't have been worth me going through insurance, so I just paid it. The insurance organization will determine if the event is covered, and if so, they'll pay a deductible, which is the out-of-pocket money paid by the policyholder before the insurance company will pay anything. So my deductible in that case was $250. So I could pay $250, and the insurance company maybe would have had to pay $10 or $20. Otherwise, I can just pay it on my own and not go through insurance. The remaining amount is paid by co-insurance if that's applicable, and that requires the insured individual to pay a fixed percent of the loss after the deductible has been paid. So here's an example from Louise. She has a health insurance policy with a $500 deductible and 20% co-insurance. So this means she first pays $500 of any medical care, and then she pays 20% of the remaining costs. So if she had an accident with $5,000 medical procedure, she'd pay $500 plus 20% of the remaining $4,500 for a total of $1,400. And the insurance company will pay the remaining $3,600. So even with insurance, Louise still needs funds to pay the deductible and co-insurance. That's why that emergency fund is so important. And what would Luisa's options have been if she did not have insurance? She would have to figure out a way to pay that full amount, that $5,000 amount, because without insurance, the insurance company wouldn't pay anything. So you do the math. Carlos was involved in a car accident that resulted in $3,788 worth of damage to his car. How much will he pay, and how much will the insurance organization pay? He has property and liability insurance with a $500 deductible and 0% coinsurance. So how much would Carlos pay? Remember, the deductible is paid first, so he would pay $500. Does he pay any more? Nope. He has 0% coinsurance, so the insurance organization would pay the rest. Which insurance policy would you choose? Janet wants to make sure she has the best health insurance policy. She shopped around and received multiple quotes, and here are her choices. So her current policy, she pays $300 per month for her premium. She has a $200 deductible, and then her coinsurance, she pays 20%, and then the insurance will pay the other $80. Under her new policy, which is called a high deductible plan, she'd pay $200 per month, but her deductible is now $2,000. But she owes 0% after that amount, and the 100% is paid by the insurance organization. So which policy is better? It's hard to say. We don't know how much insurance we're going to use, so we don't know which one we'll end up paying more and which one we'd pay less. Depends on how much we'd file for claims to depend what would happen, which is the unknown. So why do insurance policies include deductibles and coinsurance? It reduces the problem of moral hazard. When the act of insuring an event increases the likelihood it will occur, deductibles and coinsurance place some of the loss on the policyholder. For example, not locking a car or parking it in a theft-prone area in hopes it will be stolen and car insurance will pay for a new vehicle. So deductibles and coinsurance put some of the blame onto you before it goes to the insurance company so that there's not more accidents or insurance have to pay than they should. Dollars paid from an insurance policy are not intended to make a person better off than before the loss happened. You're not supposed to get a $50,000 car if you had a $20,000 car. It's meant to put you back where you were before the accident happened. Sources of insurance. In most cases, individuals acquire insurance from a combination of sources. Long-term care, property, and liability insurance are all purchased individually. The employer may purchase health, disability, and some life insurance for their employees. And the government may provide special programs for those who qualify and during catastrophes. So if an employer does not provide insurance, it may be acquired individually because a lot of these insurances from the employers are only if you are a full-time employee. Employer-provided insurance, there's employee benefits, and those products or services that add extra value for employees beyond earned wages. And insurance premiums paid by the employer are considered in-kind income because it is in place of cash. You're getting another kind of benefit. And the employee would have a payroll deduction taken out of their check so that they could pay for their insurance. Policies may be available to the employee's family members, usually for additional fees, and there's no income taxes paid on the in-kind income, so it is tax exempt. Government programs provide basic insurance as a part of the social safety net to protect citizens from economic hardship, like Social Security, Medicare, and Medicaid. And many programs require a work history and employer-provided participation to be eligible, such as unemployment insurance and workers' comp. And it can address specific catastrophes as well, such as a hurricane. So now we're going to get into the different parts of insurance, and that will be in our next presentation.